What's up, y'all? Welcome to the Legacy Podcast. Tim Bratz here, and today I'm sitting down with my boy Chris Litzler, who is my commercial mortgage broker. He's with Marcus and Millichap. I have been working with Chris since the very beginning. He's helped me build my portfolio to thousands of doors. I've probably closed more than $400 million of loans with him, and he's an absolute rock star. He speaks on stages all over the country. He's seen as one of the foremost authorities in the commercial mortgage space, and is somebody that I go to for business insights, for feedback, what's going on in the marketplace, helps me troubleshoot any issues that I'm going through on any of the deals, and is an integral part of my team. And so he doesn't work for me. He's got his own company, so you're welcome to do business with him as well, and I would highly suggest it because he's an absolute rock star. So I'm excited to sit down with him. We're going to be talking about what's going on in the marketplace, what's happening with interest rates, what's happening with the commercial mortgages, what's happening with lenders, what are they seeing out there, and how are they responding to what's happening in the marketplace, and a little bit of forward thought on what's going to be going on and what to look for in the real estate space over the course of the next couple of years. There's a lot of moving parts and a lot of variables feeding into a couple of different things that are really going to drive demand in a few certain asset classes. So I'm excited to dive in to all that stuff with my boy Chris. Litzler, what's up, homie?
Good to see you, man.
Always good to see you.
Welcome back to Cleveland.
Dude, it's good to be back. It's good to hang out with the team and at the office, and but you know, it's like you step back in.
It's a summer spot. It's a summer spot.
Yeah, it's a great summer spot, dude. I love Cleveland summers. I love being up here because the weather in Charleston, man, is just like humid and hot and horrible. And I live on the island, so it's like all the tourists go there, so you can't go to any restaurants in the summertime. Like, it's just chaos. I can't get on and off the island because the traffic's crazy. So, dude, I love coming back to Ohio. Yeah. And I'll tell you what, man.
Grandparents get to see the kids. They love that.
And dude, the more I travel, I was just in New York this week. Like, dude, me personally, I love visiting New York. I would never live in New York personally. And I don't know, I keep on coming back to Ohio. Like, it's a great place to live.
Chill, easy to get around.
Dude,
people are nice.
Low cost of living, Midwestern values, right? It's a great spot. It's just, you got to muscle through 3 months of like really horrible
treacherous.
Winter.
Treacherous.
Yeah, and gray skies and all that. But I like the balance that I have right now, so I'm good with it. Good. So cool, dude. Well, dude, Cam and I were talking. I think it's been at least 2 years since we've done an actual Legacy podcast. By the way, we changed the name of it. It used to be Spilling the Beans. Now it's the Legacy Podcast, which makes a lot more sense, right?
I like it.
Yeah, it's more on brand with everything else.
Consistency.
Yeah, and so dude, now that I'm back in town, would love to sit down with you. I want to talk a lot about what's going on with the markets, interest rates, what you're seeing with the whole housing market. Specifically, we could talk about like affordable housing, talk about new construction, talk about what are lenders going through right now, and hit on all of it. Because I know we've had a lot of conversations offline on stuff, but I think it's really important for people to understand what's happening and the opportunity that's out there, what's not out there, what they need to be paying attention to, and all that stuff. So today is July 31st, and this episode will come out this Sunday. Tell me about where the markets are right now, and kind of just give me a high level. Somebody's coming in, they're trying to buy some apartment buildings or commercial real estate. What's the conversation that you're having with them right now?
So let's start with where rates are today. Two sides of rates. One is overnight borrowing, which the Fed meets today, and they control that. That's the Fed funds rate, which correlates exactly to SOFR, right? And then you get the long end of the curve, which is 5, 7, 10-year treasuries. Curve's still inverted, which means 2-year is higher than the 10-year, right? And
so what does that mean?
So that means that it's more expensive to borrow short than it is to borrow long, right?
And we've all heard about this inverted yield curve, but like explain what that means. So if it's inverted, it's more expensive to borrow short-term money than it is long-term money. What is that saying about the economy and what the Fed sees or what the market sees?
Yeah, so typically when there's an inverted yield curve, which means the yield on the 2-year is higher than the yield on the 10-year, that there's a recession imminent, right? That's typical. That's a typical kind of forecast, right?
And the idea behind that would be a higher interest rate means there's more risk, right? And so if there's more risk in the short term, then that means it's because of some sort of economic turmoil that could be happening. People are seeing 2 years out as more risky than something that's more 10 years out, right?
Yeah, that's right. Think of it this way: like if you're going to issue money, typically you would get the lowest yield for having the least amount of risk, right? It's only out for 1 month. It's only out for 2 months, right? You should get less yield than taking that duration risk, right? That's just not the case today. Because what the Fed has control of is the Fed funds rate, and they're using that tool to try to cool off the economy, right? We went through a period of declining interest rates, near zero interest rates, which really made the economy run really hot. They have that tool to slow it down, right? Inflation is high, so they increase the Fed funds rate to slow down the economy, hopefully reduce inflation while not having unemployment tick up too much, right? So that's a tool that they've used. They've signaled that it's kind of at the top, and we should expect it to come down soon when they get a better handle on inflation. Inflation is in the high 2s right now. They want it to be at 2%.
Dude, I feel like inflation's more than 2%, right? Like I was in New York, I was telling Cameron, my wife went and got a razor and toothpaste and like something else from the store. It was $47. It's insane, right? We took a pedicab for 15 minutes and it was $145.
So think about what inflation is. They're saying that inflation is up 2.8% annualized, right? So what that means is prices are up for this basket of goods 2.8% since last year, right? It doesn't factor in, it's not like prices are going down, right, relative to where they've been in the past. So you had 7%, 5%, 2%, so compounded, right? You're up massively, but the rate at which we're increasing is slowing.
And so really the only tool that the Feds have is raising and lowering the interest rate. And they said back in December that they were going to start lowering the interest rate pretty considerably, maybe 4 to 6 times this year. They have not lowered it at all. And it's now July, right? So we're more than halfway through the year and they still have not lowered the interest rates. What does that tell you about what the Fed sees in the economy and like looking forward?
Yeah, what the Fed sees is they don't feel like they have a clear enough picture that inflation's under control, right? So they're balancing a 2% employment, 2% inflation target and full employment. Those are the two mandates that they have, and they have the Fed funds rate to manipulate it, right? They also can buy bonds to stimulate the economy. They've really been letting some of those roll off, so they haven't been buying. By them keeping the Fed funds high, they are not confident that inflation is going to come down to 2%. Now, monetary policy, it's been said, has like long and variable lags. So even though they raise rates, they really need to let it sit for a while to have full effects. And in fact, sometimes the effects could still be out there, right? So they're saying recently that they don't need to see it go all the way down to 2% to start cutting, but they need to see they need to be more comfortable that they're on the path to getting there. So the Fed actually never said we're going to cut 4 to 6 times, but the market priced in 6 cuts in 2024. We've had 0, right?
And so what has that done to rates over the past 6 months?
Yeah, so Fed funds, so SOFR has stayed at exactly 530 since the last hike, right? And that won't move until they cut. There's a meeting today. There's a meeting in September. There's really no probability that it's going to cut today, but they might signal that they will start cutting in September.
So what does that mean for interest rates to borrowers, though? Right? Because even though the Fed rate has stayed the same, rates have fluctuated slightly up and down based on what the market is doing and what people are seeing, right? And so what have you seen both in the short term, let's call it bridge loans, and the longer term, like agency debt that you guys are placing?
So no change in the short term, right? So we have SOFR at 530. It hasn't moved. Spreads have stayed pretty flat. So construction loans, right, that are priced on floaters, bridge loans that are priced on floaters, really no change in pricing.
Got it.
The long end of the curve is set more by economic growth, inflation expectations. We saw that get up to 5% in October of last year, came down sub 4% at the start of the year. It ramped back up, and it has come in meaningfully over the last couple of months. The reason that it's coming in is because you're starting to see a deterioration in the labor market. Unemployment was down to 3%, it's up to 4%. You're starting to see more job losses. People are starting to maybe think that the job losses are underreported and that the unemployment rate has a little bit of risk that it could keep going higher. And that's why you're seeing the Fed kind of start saying, well, now we have two things to think about. At first it was the labor market is so hot, right? We don't really need to worry about the labor market, but inflation is so sticky that we need to keep rates high. Now they're starting to say, well, now we have both things to consider. Unemployment rate's coming up a little bit, inflation is coming down, but it's not quite there. So now we need to start thinking about making a move, right? So as we speak today, 5-year UST 4%, 10-year UST 4.10, right? That's in meaningfully from, in the mid 4s and even close to 5% last year.
So what does that mean if somebody has a stabilized rental property, apartment building, or some other commercial property that they're going to finance with agency debt or CMBS or life insurance company? What is the interest rate coming in at on something stabilized?
So we've seen spreads come in a little bit. So agency full leverage loans priced probably in that just under 200 basis points range.
Okay.
So 410 plus 200 puts you at 610. 190 puts you at 6%. Tier 3, so that's 65, 135. I mean, we're getting 160s, 170 spreads.
Really?
So I mean, we're locking deals in the high 5s for 5-year deals. That's what most people are doing, is doing a little bit shorter deals, just with the expectations that hopefully rates will come down a little bit. Hopefully they'll be able to grow rents and be able to recoup some equity down the road. But yeah, I mean, at that level, deals are happening. There's not a lot of elective refinances happening. So you have 3 years of term left, you're at 4.5%. Like you're probably not calling to say, hey, let's go refinance this deal early. You're probably not electing to do that. But the stuff that was stuck, right, it's on a bridge loan or it's a construction loan, we are able to get out of a lot of those deals. Not returning a ton of equity, but we're able to replace the first mortgage.
It's really, really good insight. And a lot of depth in that, so I appreciate that. What you had alluded to, rent growth. What are borrowers talking about in the rent growth outlook right now? Right? Do they think rent's going to grow pretty dramatically? Do you think that's kind of like outside the scope? Is it I mean, rent growth a lot of time, like anybody can make financials look good, like growing the rents enough or playing around and not fudging, but messing with the numbers and
high end of market and a lot of rent growth is the main driver of the model, and that's what moves the needle. Right,
and so are we seeing rent growth? I'm seeing article after article about, especially some of the big, really hot markets over the past few years, the Charlottes, the Phoenix, the Miamis, a lot of those really, really, the Dallases and all those, that they have rent attrition right now. It's like it's coming down. It's not growing. And how are you guys underwriting that kind of stuff? And how are lenders looking at rent growth when they're looking to give loans on some of these things?
So I'll answer your question first, and I'll tell you what I think is going on. Rent growth is really only modeled kind of on a bridge loan or a construction loan. And I'll tell you that we're not really growing rents. Lenders are really underwriting to untrended, stabilized rents. So if this property were stabilized today, what do we think it would rent for, right? And we're not taking 3, 4, 5% rent growth into the future. We're taking untrended rents. So that's the answer to that question.
So looking at what will it rent today, assuming it's not going to increase in rents at all, like just
over the long
does
term,
this make sense now with today's rents?
With today's rents. That's on a construction loan, that's on a bridge loan. On a permanent loan, never was really factored in, right? Just current T3 collections, market expenses, got to cover at today's interest rate. So it never really was a component. But what's going on with rent growth depends totally on property type. So I'll start with kind of traditional CB quality stuff in, normal secondary type markets, right? That we're seeing rent growth there. The reason is there's just no new supply coming online. There wasn't any new supply coming online. The cost to build this stuff is too expensive to justify those types of rents. So we are seeing rent growth there. That's being offset a little bit because you are seeing that renter be able to move up in quality. The reason being there is a lot of new supply coming online in that A quality stuff.
Is there too much A quality supply where it's almost, there's so much supply they can't fill it with A quality rents, so those rents are coming down, and then a lot of those BC are kind of moving up into that?
Yeah, that could be happening for a blip. For a blip. What happened is in 2020, 2021, you had a lot of new construction permits and starts. That stuff is now delivering right now, right? But there's been no starts over the last 12 to 18 months. You've seen a huge drop off in permits and starts. So yes, we had a period where...
And that's all measured by people pulling permits.
Correct.
And getting approvals at the building departments, which is all public record that anybody can go out and see. So you can pull that and understand that's fallen off a cliff over the past 18 months.
That's exactly right. As SOFR went from 0 to 5.25, right, it makes borrowing on a construction loan virtually impossible, right? So you are seeing slightly rents come down in the A quality stuff because of this supply that's coming online. But once it absorbs, and it will absorb, right, there's no new stuff coming in to backfill it. So it's really a 25, 26, 27 story where, you could see a shitload of, it's very possible to see a ton of rent growth.
Grant Cardona's been doing some social media content on that. I've seen Kent McElroy talk about it. I've seen a lot of economic analysts and stuff talking about it. I've talked to you about it. I've talked to different lenders, bridge lenders, mezz lenders, equity groups, debt funds, and that seems to be a very communal, consistent understanding of what's going to happen, because there is just zero, especially in the affordable housing sector of things. There's just nothing affordable, right? I just saw something, 4 years ago, the average single-family home price was $307,000. Median, not average. Median home price in America was $307,000. Today, in just 4 years, it has increased to $427,000. In 4 years, it's grown by 39% home value, which, we were talking offline of that's exactly how much the federal debt has increased as well. And it's, in lockstep with that, which makes a lot of sense. And, but it's who can afford that, right?
At the same time, when you went from 307 to 427, you had interest rates go from 3.5% to 7%.
Yep.
So your affordability is totally flipped.
Yep.
So the new first-time home buyer, simply just can't afford a new home.
First-time home buyers are out now. And anybody who wants to grow, they're not making enough money, right? And wages have not grown enough to catch up to that, right? And we're talking single family, but in the single family world, you need to have about a third of your income is the most that they'll allow you to allocate towards a mortgage, right? A mortgage payment. And so it's you need to have a household income of $120,000 in order to afford, or $130,000, $140,000 in order to afford that.
The median home.
The median home.
Right. And what is median household income?
And the median household income is $75,000.
Right.
So it's off by
double.
Almost double. Isn't it? It's so what happens? What does that mean for the marketplace? And everything is pointing towards more renters and rent growth in the long term. To your point, I think there's going to be a lull of the next 12 to 18 months of if you can keep your head above water over the next 12 to 18 months and just maintain the status quo. I don't think get too good or too bad or whatever, but I think if you can hang on, and especially if you have single family homes under $300,000, and if you have multifamily under $100,000 to $150,000 a door, you just can't build it for that. And so I think you're in a great spot if you can hold those in your portfolio or accumulate those in your rental portfolio.
You're going to have to deal with no cash flow for the foreseeable future, right? Because you can't pay today's prices with today's interest rates and get any cash flow. But hopefully you get a little bit lower rates and you get some rent growth and they turn into great deals.
Yeah, I mean, we've talked about this before, but like the whole idea of cash flow and like retiring off of cash flow, especially on a new acquisition, is just not realistic, right? Like the real wealth is built in buying properties that you get a bunch of depreciation. It offsets, a lot of your rents and your active earned income if you're a full-time real estate professional. It's the principal pay down really that is the key. Paying down the principal, letting the rents grow. Fed keeps on printing more money, and now it takes more dollars in order to be able to acquire that. And if you have fixed rate debt in place, you're paying for that fixed rate debt with future cheaper dollars, in order to pay for your assets. So I think, if you have that staying power, being able to hang out for the next couple of years and be okay with zero rent growth, realizing that depending on the market, depending on the asset class, that could be growing pretty substantially, the rents and what that does for your property. I think a lot of people would be sitting happy if they can still maintain good management, good operations over the next couple of years.
I think you're right.
We've seen a lot of curveballs in the market with interest rates, with insurance costs, with all labor costs, with all supply and material costs, and all those things going up. But what I've seen is the biggest effector of valuation has been shitty management, and shitty operations, bad asset management, bad property management, and just controlling what you can control, right? And a lot of people are pointing the finger at all these other different things, all these other variables. And the reality is like the most important thing is like just control the operations. What have you seen in that side of things?
So you're exactly right. The first thing that we always recommend to folks, like if they're in a bridge loan and coming off a construction loan, is you need to get the property stabilized. Because until you hit 90% plus occupancy, you have way less options. But once you get the property stabilized, you have some flexibility. You can create a lot of different situations. That's where the guys get in trouble, and that's where you start looking at management. This is a leasing issue. This is a communication issue. This is a marketing issue. But look, no third-party property management is going to be excellent, right? It's a thankless job, not a lot of money in it.
Yep.
So what we've seen is actually a lot of guys trying to bring it in-house.
Yep. That's what we've been doing.
To try to control it.
It's just, when you have third-party management, you're in a reactionary mode all the time, right? There's layers there, which in theory sounds amazing because you're like, oh, I could be a passive owner. You can't be passive, dude. You gotta actively manage your properties. And like our team is on phone calls every single week with our property man, and there's still stuff that they don't disclose to us, that we don't find out about until months down the road. And it creates like these bubbles of issues that have popped up. And on all the things that we've taken in-house, where we now control it in all the property, we have real-time data, we can make real-time decisions, we can pivot immediately, not let anything grow into a position where it's like it's too big of a problem down the road, where we've run into that over and over and over again with third-party management. And so I think that's something I really took to heart when you told me that about a year and a half, 2 years ago, when I asked you like the biggest owners, the biggest balance sheets that you bank, what's a commonality amongst all of them? And you'd listed off a few things, and one of the things that we weren't doing, other than locally in Cleveland, was in-house property management. And I was like, I need to do that across the board. It's a pain in the ass, but it's like, you got to do it.
There's three things that that third-party management companies have to do. They have to lease, they have to handle maintenance, and they have to bookkeep. I've never found one that does all three right.
Exactly.
Right? You might get two.
Oh,
You're never going to get all three.
Yeah. It's like that contractor thing. You can have quality, you can have price, or you can have timing.
You're not going to get all three. That's right.
All three.
That's exactly right.
So what are the conversations looking like with the lenders? With these, like, dude, I just read an article that, it was on Real Deal, and the tide's equity group, 30,000 plus units. They bought a bunch of stuff, right, over the past few years too. They're handing things back left and right now. They have 30,000 doors, and they're not immune to these market conditions, operational conditions, things like that. What are the lenders saying? Are the lenders scared shitless? Are the lenders confident in the market? What are the different lenders saying on both, the bridge loans, the mezz loans, the debt groups, the debt funds, and then like the long-term lenders as well? Like, what are they looking for in a good borrower or a good deal? Like, what kinds of things are they excited about, and what kinds of things are they like, I need to stay away from this?
Look, so the first thing that everybody wants to see is real cash in the deal, right? So, I mean, we were doing 80+% loan to cost deals in 2021, a lot of bridge loans. Today, more equity is a good thing, right? Or if your deal's not performing great, showing that you're committed to the deal by bringing more cash is a good thing. The second thing is communication, right? A lot of times when things aren't going great, people shell up. They don't over communicate. Communication is the most important thing. If you're communicating, doing the right things, for the most part, lenders want to be flexible. The permanent lenders, so longer term fixed rate loans, we're really not seeing much issue, right? Because the stuff that was bought at the peak 2020, 2021, those rates were low, right? 5, 7, 10-year loan at that time. Even if the property maybe declined a little bit in value, at least can service the debt and it's fixed, right? So we're not really seeing any issues there.
What percentage of loans that are out there, give me a ballpark, are on these loans that were refinanced over the past 3-4 years when rates were very, very low? Like, is it I don't know, 60% of the loans out there are already on fixed rate debt with low interest rates, and so the boat's not getting rocked that much?
That's probably right.
Are we expecting, like, when those all come due, like most of my fixed rate stuff is like 10-year terms, right? We did mostly 10 and 12-year terms across the board. I think there's one, maybe two that are less than 10 years that I have that are fixed rate, agency at least. And so, I'm looking at this and I'm thinking, a big thing in 2008 was wait until the arms adjust, right? And as soon as the arms adjust, everybody's payment goes up by 3x, and then all these properties hit the market, everything gets foreclosed on, everything goes back to the bank, and too much supply, not enough demand, all this other stuff. Is there a timing thing? Are we expecting that?
This is a good point. What's really the relevant question is the stuff that got bought at the top. What percentage of that stuff is on the floater? That's the question, and it's north of 50%.
Really?
We were doing. Every deal that we were doing that was openly marketed. To make the numbers work, you had to get the leverage. You had to have the flexibility to be able to get in and out of it. More than 50% of these deals were on the floaters. And that's really just a matter of time. Typical structure for that is a 3-year deal, 2 1-year extensions. So you're starting to get into those extensions. The lenders, even if you busted a covenant, are really being pretty flexible to just give you more time. They're extending and pretending that everything's going to be okay. And with rates,
if they don't, I think there's this influx of properties that they got to then asset manage, and they don't want that shit on their books.
They don't want it. That's exactly right. If somebody's willing to keep throwing money at it, they'll let them do it, right? If there's a path to get out of it for a sale, to get out of it to be made whole, they're going to let you do it. Keep in mind, even the stuff that was bought in, at the top, that stuff, if it's performing, you could at least get out of the debt.
Yeah.
Right? Like you could sell it and the lender would be made whole. So they're in an okay spot, right? A lot of deals have equity wiped, but the lender's sitting there feeling okay. And if rates do continue to come down a little bit, then it gives the borrower an avenue to hopefully be able to refinance. Maybe need to write a check, but at least they're made whole.
Yeah. It's an interesting market, right? Because of all these different variables, and some usually the variables all kind of like play going in the same direction, and now they're all in different directions, so it's hard to kind of like conceptualize. Well, inflation's down, but unemployment's now back up, and then rates are steady, and then this and that, and all this other. It's like it's hard to conceptualize which way the market's going to go. But I think there's some of these specific indicators that are like simple supply and demand.
Yep.
That to me is like the simplest explanation and the one that I'm paying attention to because of that. It's like, dude, if there's more property and less demand, or more demand and less property, right? Prices are going to go up, and rents are going to go up, and everything else is going to go up. So,
look, you can only control what you can control, right? You need to stabilize your properties. You need to get off the floaters, right? Because you can't just keep bleeding cash.
Yep.
And you need to just buy more time and give yourself a hedge to survive.
I think that's the key, right? It's doing exactly that, right? Control what you can control, get the property stabilized, do those things that you mentioned. Friggin' take care of the properties, get units online, rent them, and then collect rents.
Yep.
Like that's all. Like just focus on those couple of key performance indicators that you can control. Once a property's stabilized, now you got options. Now you can refinance into another bridge loan if you have to. You can refinance into agency or longer term debt, fixed rate, variable, like whatever you want to do. You have options once it's stabilized. You don't have many options. It constrains you big time if you don't have those options. So control what you can control, and it's a little bit of a waiting game. It's a little bit of just kind of like ride it out, buy more time, because over the long term, typically real estate wins, right? Typically, if you can just, you see the rents grow, you pay down enough principal, and eventually there's enough spread where now you're above water again, you can breathe a little bit, you can sell it, you can refinance it, you can exit it at some point in the future. And if that's the worst case scenario, it's not a bad worst case scenario.
Right. If you can refinance your deal, reduce your debt service cost, the LP equity doesn't get returned in full, of course. Like it's just that's not the nature of the cycle that we're in today. But you can start paying the pref current, right? And you just say, hey guys, like we're gonna keep you current, and this thing's it's gonna take a few years, but we'll evaluate in a couple of years.
You'll be made whole. Right?
It's better than, hey guys, we're selling a deal today and you got a 50% loss, right? So it's not ideal, but it's a solution.
I agree. What would you say to people who are going out and trying to raise more money, but the deal's not stabilized, but they can't get it stabilized unless they have access to more capital?
And we call it last in, first out money. So that's really the only solution to do it. You have a bridge loan that's your bridge loan or first mortgage that's in place. You have LP equity on top of that, but the deal needs more cash to stabilize, right? Well, you can go to your investors. You say, hey guys, we got a capital call. Everybody needs to chip in XYZ dollars. Good luck with that. That ain't gonna happen, right? So the only way to do it is you need to come in, bring in new money. That money sits right behind the first. We use that money to cure, stabilize the property, refinance. This money gets paid back first, and anything above that goes to the LP.
Yep. We've done this with one deal so far, but I'm going to do it with another one that's construction. Just need to bridge the construction a little bit, but I think that's the best fit. It makes it attractive enough, it makes it safe enough, it makes it where you can go and raise capital. Because, dude, I've found over the past probably 60 days, the whole LP world and people who want to passively invest has grown substantially. People were all on the sidelines, people were all waiting, but I found a lot of people knocking on doors saying I want to put money in play if it cash flows.
Okay.
If it's paying dividends.
Right. Yep.
Right? I don't want to put it in play if it's going to sit there.
Yep.
But I'm very interested if I can put it in play and it's paying me on a quarterly basis. Yep. So if the property's cash flowing, or you can treat it more like a debt versus like an equity position where it pays me out on a regular basis, then I'm finding that that's not difficult money to raise right now.
What type of deals are you seeing LPs interested in? From a, do they must not like construction if they want current pay, so they want to buy existing deals, newer vintage. What kind of stuff are people interested in?
I think just stabilized stuff. Yeah. More stabilized where they know that there's a safety net where they can get paid, especially if it's an LP position. If it's a debt position, I had one deal that I had to take back from an operator. That's 30% occupancy, dude. It's an ugly, ugly deal. And one of my investors is like, no, I'm good with it. Just treat it like a debt. And I made it a rock star deal for her. I'm giving her 50% of all the upside beyond the money that she's into it for. And then we created like a little bit of a note to make sure that the current LP investors are taken care of. But that was the only way that we could get somebody to come in and write that big of a check for that distress of a deal, is we had to make it super attractive. And so, again, like her big thing is, I just want current pay, right? Like that's number one for her. Number two was she wants the equity upside, but she doesn't want the downside either, risk. And so she sits in between that first lien and then the LP investors. So she gets her money back and her return first, and then the LP investors. But you know, somebody might be like, well, what about the LP investors? Like they're put in a worse position. No, they're put in a better position because the property's gonna be more stabilized. It's more likely that they're gonna get their money back. Because we just sell right now, they're not getting much of the LP portion back at all. So, but communicating that, right? Making sure you're in communication. So, dude, this has been super, super helpful.
One more point.
Yeah, please.
Is the other thing that we're having a lot of success with is offering those terms to your existing investors, right? So we have a deal, it's stabilized, I'm gonna refinance it, but I can't get everybody's money back. So I'm gonna bring in new money to clear up everybody else. It sits right above the first, right? But it's a little more expensive, right? They may be getting 8 to 10 today, and that money might be 12, right? And so you're gonna bring in some money to clear the top of everybody else. Well, you just say, hey guys, like I can give you your money back, but you're not going to be receiving any cash flow because we're going to get it's going to be serviced by this MES. It's effectively MES, or you can receive, but I'm giving you the right to receive the same terms.
Yeah, I'd rather pay some people that I know rather than bring in somebody outside.
Bring in the fresh money, and that's working well.
I can see that. I can see that working well, really well. So, dude, super, super helpful. Lots of good stuff. It'll be interesting to see what the Fed does today or what they allude to for the remaining part of the year. There's a lot of conversation of like a rate drop sometime before the election to try to manipulate things. I don't know, but control what you can control.
That's right.
That's the key.
You're the man. Good to see you.
Dude, well, I appreciate you, man.
Always.
If you guys need any sort of financing needs whatsoever in the commercial sector, how can people get a hold of you, Chris?
Email's best. clitzler@marcusmillichap.com. Shoot me a note. We're pretty responsive. Love to help anybody in the family.
Yeah, and we'll put all the information in the show notes. Reach out to Chris. I tagged you in something this morning. Somebody's looking for financing on a commercial deal, and I was like, Chris Litzler's the man. He's gotten over $400 million of loans for me, and da-da-da-da-da. So this guy speaks on stages all across the country. He's seen as one of the best, most brilliant minds in the entire country in the commercial mortgage sector. So definitely reach out to him. I go through him for everything that I need because he gets it, right? And he understands how to explain it really, really well and have the conversation and be a medium in between me as the borrower and the lender to make sure that the conversations all lead to the same result, which is getting a deal done. So connect with Chris, and we'll see you guys next week on the Legacy Podcast. Hey, I really appreciate you guys being here for the Legacy Podcast. If you would, please subscribe, like, and ask any sort of questions that you have in the comments of this video. I'd be happy to create some other content and answer any sort of questions that you might have. So I appreciate you being here. We're here every Sunday. I'll see you next week on the Legacy Podcast.